start and then I'll take roll. I can do that. I could do that. I just got us recording, so we're
Okay.
good to go.
Okay, good morning. Today is Friday, August 2nd, 9 a.m. Oil and Gas Investment Board. Can you please take roll, Kelly?
Jermaine Sullivan.
Here.
Wesley Smith. Here. Jeff Rowe.
Here.
Doug Parks. Here. And Ed Bradford and Bill Gamble are missing today.
Okay. Old business, Hound Resources, royalties.
And that is in your packet, and it just shows what, for the last fiscal year.
So we're not gonna go over this whole thing, right? No?
You don't need to. I mean, you
Okay.
can see what we're at. It says
So I will go to approval of minutes from
TS.
April 19th, 2024. Oh,
TSM.
There you go.
Oh, there it goes.
Well, you're so tall.
All right, that should do it. All right.
there's a second.
Second.
Okay.
Sorry, I was waiting for Kelly to come around.
I'm here. I am here.
It's all good.
Okay, investment advisor update and commentary. I'm assuming that would be you.
Is Troy on there yet? Let's, if you don't mind, maybe about 1 minute, our partner will be on the call and get up to speed.
I did include, and it would be under other if we were going to talk about it today, but the letter that Ed sent, that Hound has sold the
Anybody have
assets.
any questions about that?
I feel like this is like the second or third time they've sold, well,
Yes.
since I've been sitting
Yeah.
here with you guys, I don't remember.
Well, it was originally, I forget who it was originally, then it got to Aztec, and
Yeah,
they always seem to misaccount things when they change hands.
yeah, I think that's the biggest thing, but.
Yeah, I think that it'll go smoother than the last time, because I think there was some issues with getting those payments through Hound, so.
There used to be argument on, because the city's contract had pre-production percentages and most everybody's post-production cost
Are you
percentages.
connecting?
So there were lawsuits back and forth and arguments. So you-
Oh, okay, hold on.
And they were doing Christmas
That was
parties
not
as an
a
expense.
Zoom invite. You sent him an Outlook invite.
It's not in Zoom, it's a Teams.
Oh, Teams, okay. It's a Teams invite. Let's see. Let me see if I can forward what I had from Kelly. Hold on a second.
Where is Washington Township?
Let me see, this one might work.
I wonder.
Wait a minute. Let's see here. I've got it on my. How would you forward that to Troy? Here, I've got this, but
Maybe that one will work.
I forward that. Oh, here, maybe that.
Yep. Oh, that's just. Technology is always what gets us at these meetings.
Well, if we don't get it in the next minute, we'll just get started.
Okay.
Sorry, apologize. Did you get that?
Down in Macomb County.
Yeah, that's what
I forwarded it from my email,
And I sent him a different one also.
and then Kelly sent a different one. Yep. Okay. Well, we'll just get started, because he's going to pick up
Okay.
later for us. So some of you, I think you know, first of all, thanks for having us here. Always a pleasure to be in Manistee, see everybody real.
Yeah.
So Normally what we'll do is we'll go through the environment, the investing environment, the economic environment, kind of a review of the capital markets, and then we'll kind of dig into, we have a special topic today, and I think in the last few meetings, we've tried to be a little more kind of educational or consultative with something that's relevant to the portfolio, that digs a little deeper rather than kind of just kind of a surface overview of things. And today, we're going to talk a little bit about artificial intelligence and the relevancy in markets today and to the Manistee portfolio. And then we'll talk more about some details about the portfolio, and then we usually end with a performance summary. So we'll start with page 4. This is under tab 1, which is Bartlett's market assessment. And I'll hit a few high points, and then Brian will pick up with some of the charts. And you can see we still have really a pretty good environment for investing. We have low to moderate inflation. We have a growing economy. We have somewhat low interest rates relative to a longer perspective. If you've got into the financial service business in the last 25 years, you think rates are high now. But if you go past 25 years, you realize that they're actually closer to normal, if maybe not a little bit on the low side. So we have a good economy, good inflation, good employment, but there's also a lot of kind of fragility in the world with debt, geopolitical pressures, stock market valuations are high. You know, there's always issues, let me put it that way. And so overall, we're encouraged about where things are, but we don't take it for granted, and we continue to rebalance the portfolio as markets go up. We rebalance to the equity targets to keep risk in line.
All right, I'll have you flip to the next page, page 5, and yeah, inflation's kind of been the salient issue that held markets back and caused all the volatility that we had a couple years ago. And you know, on the other side of that, the improvement in inflation over the last 2 years has really allowed the stock market to rebound. And so just wanted to point out here you know, how much things have improved, and that it really has allowed the market to perform well this year as well, off of the heels of a strong 2023. So the blue line is the CPI number. That's a number we're all familiar with in the headlines regarding inflation. You know, that peaked at over 9% just about 2 years ago, and really came down pretty quickly right after the Fed started aggressively raising interest rates. I wanted to point out this other line. This is called the PCE. It's a different measure of inflation, and I won't go into the details on it, but it measures housing a little bit differently. And the Fed thinks it more accurately represents where inflation is. So that number is actually closer to 2.6 at the last reading. We had a really good reading last month when that came in.
I think let me jump in here. Sure. I think the relevancy is, I think most of you know, because it's always on the front page of the news, is when, you know, when Brian says the Federal Reserve probably is the one body that, you know, what they think inflation is the most important thing, because they set policy off of it. And so when he says the Fed looks at PCE, that's where they establish policy, from that number, not from the blue line. I think that's what you're getting at.
Exactly, yeah. And their goal for the number that's now 2.6, the PC, is for that to get down to 2. And they've communicated that they would likely cut rates before it actually gets to 2, because when they actually cut rates, it takes several months for that to kind of trickle through the actual economy. So the message is that we're probably closer to a rate cut than we have been for some time now. I'll flip ahead to page 7, and you know, there is a lot of good news with the economy growing and inflation improving. One area of concern that Woody pointed out was that you know, valuations are somewhat stretched on the equity side right now. So this chart looks at the S&P 500 going back over 70 years. And we can see the long-term average for the valuation of the market is at about 17 times earnings for the forward 12 months. Right now, we're sitting at about 21 times earnings. So we're, the market's fairly expensive right now, and a lot of that's being driven by, you can see the bullets down at the bottom, the top 10 stocks in the market, and we'll go into this a little bit more. Not only have they become a really huge part of the index, over a third of the index, those top 10 companies, but they have an average valuation of over 30 times earnings. So those really big companies are kind of dragging up the valuation of the whole market. Now, if you wanted to look at that, as a positive, that means that the rest of the market's trading at about in line with the long-term average around 17 or 18 times earnings. So we're finding a lot of good opportunities in areas outside of these really big tech companies and top 10 companies that are driving the overall market to be fairly expensive. The next page, the impact of tech on market cap. Just pointing out, if you just look at over on the right side, between 2020 and 2024, these are the 10 largest tech companies. And so obviously some familiar household names there, Microsoft, Apple, NVIDIA. But just wanted to point out how much these companies have grown in the last 4 years. And these are the expensive companies that are driving the valuations on the past page. But if you look at NVIDIA specifically, it's a $3 trillion company now. You see it's over $3 billion in market cap, or 3,000 billion in market cap. That didn't even show up on the top 10 in 2020. That means the valuation of that company was less than 500 million at that point. And even Microsoft, a very established company, has doubled in market cap value from 1.7 trillion to 3.4 trillion. So just the growth in these large companies has just been really astronomical in the last few years, and that's kind of driven a lot of the performance in the market. So
Maybe before we jump into the topic, we'll go back to Troy. Some of you may recall that Troy manages the fixed income investments in the portfolio, and he heads up fixed income investing at Bartlett. So Troy, in regards to the economic and capital market review, any comments you might want to add? Let's see, we're not getting any sound.
He's muted.
Oh, are you muted?
Is this better?
Yeah, there we go. Thanks.
Modern technology.
Why
Okay.
don't- hold on just a second. Let's see. Can everybody hear him? That's a little.
Muffled.
Can you hear me?
It's on our end. We're just trying to get the mic set up here. Go ahead.
Oh, okay.
Maybe you can speak a little loudly.
Okay. Can you hear me now?
Yeah.
Yep.
Okay. So Woody and Brian have just touched on kind of where we've gone over the first part of the year and the second quarter. Just got some numbers out this morning after the Fed has been trying to slow the economy for quite a while with raising rates. This morning's numbers came out, and the jobs were weaker than expected. So the markets are kind of behaving like, we're moving closer to an economic slowdown, if you read the tea leaves in the markets today. So wanted to just mention that because that's certainly current information. And so, interest rates, which we've enjoyed this nice, at least from a buyer's perspective, higher rates for a while, now they're starting to turn lower. And so we've got to kind of keep an eye on that. But so the Fed is pretty much teed up to maybe cut rates in September, if not, at least once in September, and maybe the market's kind of pricing in 3 for the year now. So, that would lower the short-term rates from low 5s to mid 4s. And the rest of the bond market, the longer interest rates, have already reacted, and some of them are now in the 3% range. So we've seen quite a move down in interest rates. That should start to show up in lower mortgage rates very soon, which will be helpful to the economy. And, in many other areas, some relief on the commercial real estate front should be in the offing with these lower rates. So I know there's a lot of stress in commercial real estate. So, maybe some good things here to help the economy along. So there's fear that the economy may be slowing. And the one thing I think that's my worry area is just the federal debt is still very high. We've been in a big deficit spending mode for many quarters now, at a time when the economy was at full speed pretty much. And now we're moving towards a slower economy. And if a recession unfolds, that's typically when we have more deficit spending to help out the economy. And so the problem with our balance sheet, which is getting more and more debt heavy, is that it's likely to keep going. And all that debt has to go somewhere. It goes into the bond market, and that causes the bond market has to clear that, and higher interest rates are the resolution for that. So while interest rates are coming down now, that's a very short-term reaction to this news today, that the economy is slower and the jobs number is lower. The unemployment rate jumped from 4.1 to 4.3. So, we've got some new news there. But on the back end of this, down the road, the Fed will have to, or the Treasury will have to issue more debt to help keep the economy rolling. So it's possible we could see rates go back up just because of the sheer issuance of debt that might come out as a result of all this. So long-winded answer there, but the portfolio is well invested and diversified, and I think should we get a real slow economy, maybe a recession, the credit side should hold up fine. I think we're in high-quality credits and very diversified.
Thank you, Troy.
Great.
Any questions so far? Brian?
Flip to the next section, and this is the special section that Woody mentioned we would tee up. So just a little bit more information on the AI companies and what an impact it's had on the market, not just this year, but going back the past few years. So if you're on page 11, you can see these magnificent 7 companies, as they've been called: Apple, Microsoft, NVIDIA, Alphabet's the parent company of Google and YouTube, Amazon, of course, Meta, which is the parent company of Facebook and Instagram, and then Tesla. So those 7 companies, this is going back to the beginning of January of 2020. If you had just invested in those 7 companies, you would have quintupled your money. And in comparison to the S&P overall, a very nice return, but up about 82% in that same time period. So obviously these companies are driving a lot of that S&P return. And then if you just invested equally in all 500 companies, a 55% return. So these large companies are driving a huge percentage of the overall market return. And what that's led to is on page 12, we have a very, you'll hear this term, concentrated market. And it's these top 10 companies, and those top 7 fit into the top 10, make up 37.5% of the overall S&P today. And you can see
Of 500 companies.
of those 500 companies. The highest that we've had, at least in the last 35 years, was about 27% at the beginning of the tech bubble. So this is a very concentrated market, and we're seeing this globally. This is not just in the U.S. This is tech companies becoming huge parts of the indices globally too. Now, there's a little bit of a you know, they're also, importantly, they're also contributing a lot of the earnings. So those top 10 companies that make up 37% of the index, well, they're also contributing 31% of the earnings. So they're not quite contributing what, you know, what they're valued at in the market, but, you know, this is a little bit of a different environment than, say, the tech bubble, where a lot of those companies weren't actually earning anything and had astronomical valuations. So just wanted to point that out. And importantly, you know, while they're contributing 31% of their earnings now, they're contributing a huge percentage of the growth. So on page 14, those 7 companies, and this is year over year from the first quarter, that's the latest quarter that we have full numbers for. We'll have the second quarter numbers here soon. Those 7 companies have grown earnings year over year 52%, versus the other 493 companies in the S&P are actually down 9%. So this is actually expected to change in the second half, where we're starting to see earnings estimates for kind of other parts of the market actually increase in the third quarter and fourth quarter. So it'll be really important for that to kind of materialize and help the other stocks perform in the market. But this kind of goes back to what I said earlier in terms of how does this impact Manistee, is that we're seeing a lot of good opportunities in areas outside of these big companies, and you know, valuations are attractive. Earnings estimates look like they're going to be better in the second half of this year for areas like, say, healthcare and financial services and other areas, and especially going into next year. And we think, you know, as we get lower, some interest rate cuts, that'll allow some other areas of the market to perform. So to the extent you weren't invested in those 7 companies this year, or over the last couple years, you probably lagged the index. And but you know, we wouldn't think that's a very good, you know, fulfilling our fiduciary duty if we're you know, investing 8, 9, 10% in some individual companies as part of this portfolio. So, any questions on kind of the market dynamics? It's been a very interesting year so far.
For sure. So thanks, Brian. I do have a quick question.
Sure.
So kind of squaring what Troy had said about labor markets slowing or softening some, and you know this, you know, you've heard in earnings announcements, you know, some misses and some, you know, concerns about going forward, but yet I know the broader market is saying, hey, we think earnings, you know, outside the Mag 7 will pick up in the third and fourth quarter. I'm wondering how we square the kind of like, hey, we have a softening labor market. We have a consumer that's not accepting, you know, price pass-throughs the way we once did as consumers. And it's, you know, McDonald's had their first, earnings miss in 4 years, right? Like, so I'm just wondering, like, how you guys are thinking about that relative to the broader market economists saying, yeah, hey, we think things are going to broaden out. I mean, it'd be great if it did, for darn sure, but I just wondered where you guys are thinking in that line.
Yeah, great question.
Yeah, well, I think it's a good question, Jeff. I think there's 2 offsetting factors here. One is the Federal Reserve intentionally wanted to get these results, slowing things down a little bit to get inflation down into the target zone of 2.5%. They've been successful.
They're there, yeah.
And so now, you have to put aside the social meaning of the bottom half of the country maybe suffering more than the top half. Right. But putting that aside, and I don't know if you can, but I did for the moment.
Yeah.
So now that we have an interest rate cut, you know, we can sort of step on the gas a little bit more. So I think it all seems to be going according to the right playbook, which is things slow down, corporate profits get a little soft. The Federal Reserve, what's interesting in somewhat in my lifetime, particularly the last 30 or 40 years, has become very, very effective at kind of managing the economic cycle. Now they do it with lots of debt and deficits that keep going up. I don't know how long they can keep doing that, but they've been pretty successful. And this seems to be pretty much right in that playbook.
Right.
So I don't know. Troy, what's your thinking on that?
You know, it's kind of hard for me to hear the Q&A.
Oh.
Just the microphone's not picking up well. If you could repeat what is the question?
Yeah, Jeff pointed out that we've got a fairly soft economy and earnings missing, corporate earnings seem to be slowing down. Employment is tightening up, or not tightening up, but loosening up. There's more, fewer jobs for unemployed people, that kind of thing. And just sort of like, where does this end? Is this a sign that maybe the stock market is running out of steam? Is that a fair statement, Jeff, kind of?
Yeah, and also kind of more relative to the fact that just what Brian has said, I've heard also that there's this expectation that the earnings will, broaden out and pick up in the broader market. It feels like, well, if they're kind of softening and how do they broaden out at the same time, especially when consumers might be a little less, likely to keep growing their spending. I don't think we're on a spending cliff. I don't think that's going to happen. But if we're just kind of status quo, that doesn't lead to growth.
Yeah.
Right?
So I guess the question is sort of like, what's the prospect for, the economy to pick up again?
Yeah.
Now that it's slowing down, what's the prospect of it picking up again in the next 2 or 3 quarters? Is that dependent on a interest rate cut, or just what's your view of that, Troy?
Well, I think it depends on how bad things get. I mean, and in the worst case, the Fed would start going back to the QE, and all the fiscal stimulus would pick up more. That would be at the extreme. Before that happens, they're going to lower interest rates and maybe even lower them aggressively if it's what it needs, if we don't see a response relatively quick. And sometimes these things do take time. So, the Fed's talking about cutting rates 25 basis points in September. But if we keep seeing unemployment numbers like we did this morning again next month, when September rolls around, it's very possible they might be more aggressive at cutting rates. And so that would be their first step, would be to cut rates more aggressively. Their second step would be to do more of those emergency measures, if you want to call them that, where they're maybe go back to fiscal stimulus, where they're putting paycheck, money back into consumers' hands in some fashion. That's a relatively modern part of their playbook that wasn't done too much until the last couple down cycles. So we'll see how they respond. I think they've learned their lesson, however. The last time they really put the bazooka to it, and then all this inflation showed up. So I think, they'll have to look at that in a more balanced manner and hope that they can maybe not overstimulate as much as was the case this recent time.
Got it. Yeah, great.
Well, I was playing around here looking on some data because we talked about this concentration and the AI play and all this kind of stuff. So as of a couple weeks ago, since the first of the year, the top 6 tech companies added $3.7 trillion of market value.
Insane.
Since the first of the year, 6 companies, $3.7 trillion. This gives you some perspective. The 5th largest country in the world by stock market value is India, and has the total stock market value of $3.6 trillion.
And our top 6 companies did that.
It just added value
value.
in
Yeah.
6 months.
Greatest form of legalized gambling in the world. Well, because why'd those stocks go up? There's no earnings, no dividend to justify it. So I'm betting it's topped out, you're betting it's not. And, it isn't like they all increase their earnings by 10% or their payout by 10.
Yeah.
So there's no return on investment.
Well, I'll push back on that, Doug, because take NVIDIA. Their earnings are doubling every.
But are they returning it to the investor?
Well, they are. I mean, the stock market value went up, but the profits are going skyrocketing at the same rate that the stock price is.
Increase their dividend payout?
They don't have a dividend. I don't
Okay.
think they have.
So
very
they're,
small.
you're gambling.
It's so small.
Yeah.
Yeah,
it's
so
like
you're-
0.04%.
So what you're saying is you're gambling, saying it's
Well,
gonna,
it
it's
would
gonna
be-
go up.
Well, I
Well,
don't know. I mean,
think if I was an investor in NVIDIA, I would, why would you want them to pay a dividend when they can keep reinvesting in the
Oh,
business?
sure, no, I'm just saying though that
Yeah.
there's no return on your investment until you sell. And the only time you're gonna sell is when somebody else thinks you're dumb for selling and they're smarter than you. So
Yeah.
Yeah.
it's a gamble.
Yeah.
That it's gonna go
Yeah.
up. That's the bet.
Well-
It's not a bet that I can put in $100, I can get $10 back, I've got a 10% return.
yeah.
And-
But that's
But,
kind of
but
the
they
definition
also
of the
did,
stock market.
you know, they went from profits in 2022 of 6 billion to 29 billion last year.
Yeah.
And they'll be significantly above that this year. So, you know, they're, I think
Still-
from a capital
It's
allocation.
still to me
yeah.
like the old cakewalk or musical chairs,
Mm-hmm.
that sometime when the music stops, there's gonna be one person without a chair. And, because that's what you're betting on.
Yeah.
There's gonna be a chair for you when the music stops, because they're not sharing the profits. And so it's, you know, it's sometimes if they sell the company, okay, it gets paid out, but still. But that,
That's why you need to be careful about, you know, what position sizing and, you know, what you're paying for valuation wise, especially when there's not a dividend.
By the way, those numbers I gave you were from the market value of countries 2 years ago. So things, it's a little bit apples and oranges, but just by comparison, the whole UK market is about 3 trillion as of 2 years ago. Canada 2.7, all the way down. So it's just, it's pretty massive.
I think just to answer, one final thing, just to answer your question a little bit more directly, you know, if we have rate cuts that benefits smaller companies generally,
Yeah.
more than the larger companies, just because they're more debt dependent, and so you know that pretty quickly flows to the bottom line. And we didn't talk about small cap stocks, but the Russell 2000 is the index for that.
There for a couple of weeks.
And that's exactly why is, you know, we had
Anticipation.
that better CPI number, and, you know, they took off 10% in about a week. So hopefully that helps.
Any other thoughts, questions? Okay, well, let's go to tab 3. We'll dig into the Manistee Oil and Gas portfolio. You can see here a snapshot as of June 30. The portfolio is just a hair over 14 million. We're diversified per the investment policy statement. On the far right of that table, you see target allocation, and those numbers are from your investment policy statement. 65% in stocks, 30% in fixed income, 5% in cash. And so you can see all of these numbers that were pretty much in line with the policy statement. And the next page, Troy, do you want to dwell on that just for a minute?
Sure, Woody. Just kind of repeating what I said earlier, you know, the portfolio is well diversified. It's an intermediate focus, which is consistent with the policy statement. The duration there, 3.65, is in line with the benchmark. The yield, 484, a little bit better than the benchmark there. The government credit intermediate, which is 4.60. Lower left there, you can see the sectors that were diversified across. The portfolio is in the green and the benchmark is in the light blue. And so, you know, we have about half as many treasuries as the benchmark and not quite twice as many corporates as the benchmark. But we also have mortgages and agency notes. And you can also see in those other two tables, those other two charts, you know, the diversification across the maturity years. And then the credit quality in the lower right there is, you know, a lot of high quality bonds in the portfolio. The lowest quality there, the triple Bs, and below that would be corporate bonds that are in that index. We're not typically buying those weaker triple Bs that sometimes drift into the junk bond arena. So we're you know, focusing on a high quality portfolio, well diversified. Any questions on the bond portfolio? Great.
The next page just breaks down the sector allocation for just the equity segment of the portfolio. So you can see the darker blue line is the Manistee portfolio, and then the S&P is the lighter bars. And you can see we're very well diversified and have exposure across all 11 areas that the market's broken into. The largest allocation that we have is to tech at almost 25%, but you can see that's fairly significantly below the S&P weight. And I think that's just a manifestation of us being careful about the valuations that we're paying for. And I think if we're starting off and with a new portfolio and cash today, we would never advise having over a third in just one sector. Obviously we'll take advantage if we see good opportunities there, but just from a risk standpoint, that's why we're a little bit below. But generally, we'll have a little bit more in the more defensive sectors. So you can see healthcare, consumer staples, utilities. These are all areas that we would expect to hold up better when we have market turbulence, and that's typically a positioning that we'll hold on to.
Any questions? Next page is this is the history of the oil and gas fund in terms of where we started back in 2008, and you see the royalties and the spending rate, and then the distributions for the capital budget. And then the last column is there's been 3 periods where we or you took out excess distributions beyond the spending policy. And then if you go to the next page, you can see all of that summarized. So you've had total distributions of about $6.5 million, which is pretty close to about what you started with 16 years ago. And the next page is the performance. And you can see we have 10 years of history here. It's unfortunate we didn't go back to the very beginning. Would have been more interesting to look at that, but our system doesn't kind of pick it up quite that way when you do it. I think it's noteworthy. I mean, we're under the benchmark when you see the Manistee blend for the last year, and that goes back to kind of the hot areas of the market. We just spent some time talking about this enormous kind of explosion in this hot area of the market, which we don't have full exposure to. And so we believe in moderating the risk. We don't do as well in rapidly rising markets. We tend to do well better in declining markets, and so this kind of is reflective of that. But over the long term, we're pretty pleased with the results, and I think it exceeds our initial expectations. I mean, over just the last 10 years, the fund has returned about 7%, and we're pretty happy with that. The last tab is a detail of all the holdings in the portfolio. And so any questions, observations?
Are we doing any trimming of the Mag 7? Because with Meta or Amazon in there, and I think we have Microsoft, right?
Mm-hmm. We do.
I just wondered if we're taking any profits.
If we in the last quarter we've done any trimming. I think we did a little bit.
24.5.
I think we trimmed a little Apple. Yeah, all of the tech names have sold off a little bit here in the last 2 or 3 weeks. So I don't think we'd view it as a good time to pare them back now. Generally, we have less than the S&P in all of those names. So you'll see them in the portfolio, but if this was an index, it would be actually higher for most, if not all of them.
Sure.
So I think we're actually pretty comfortable with
Just holding.
just holding right now. I would say probably the one exception would be Apple. This is the one that hasn't sold off that much, and that also is the company with the lowest growth out of those 6 or 7 top tech companies. Unlike NVIDIA, which is growing at a huge rate, Apple is kind of growing more like a consumer staple company, but its valuation doesn't reflect that.
Anybody else got anything? You want me to move on? Nobody?
I'm good.
Okay, so we kind of touched on other, nobody else has anything, public comment? Have anybody? So I will take a motion to adjourn.
I'll make that motion.
What was the
That's fine.
Good, okay.
you used for your rating?
Thank you.
Freestyle.
Z.
No, I put a little bit of the, I usually go back to it and refer, I put my page numbers, and then I do watch the,
And his name